Welcome to this retrieval drill covering CFA Level 1 financial statement analysis. Here's how this works. I'll read a question, then give you a few seconds of silence to think of your own answer before I say it out loud. If you miss one, say the correct answer out loud once before we move on to the next question. FSA is one of the most heavily weighted topics at Level 1, and the concepts here feed directly into equity and corporate issuers, so getting these cold pays off across the whole exam. Let's begin. Set 1. The three statements. Question 1. Is the income statement a flow or a snapshot? The correct answer is a flow. It measures activity over a period of time. Question 2. Is the balance sheet a flow or a snapshot? The correct answer is a snapshot. Assets, liabilities, and equity at one specific moment. Question 3. Why can a company report positive net income and still run out of cash? The correct answer is because accrual accounting recognizes revenue and expenses when earned or incurred, not when cash actually moves. Profit on paper isn't the same as cash in hand. Question 4. Name the accounting equation behind the balance sheet. The correct answer is assets equal liabilities plus equity. Question 5. What line item connects the income statement's bottom line to the balance sheet? The correct answer is net income flows into retained earnings on the balance sheet. Set 2. Income statement. Question 6. What do you get when you subtract cost of goods sold from revenue? The correct answer is gross profit. Question 7. What does EBIT stand for, and what layer of costs has and hasn't been subtracted at that point? The correct answer is earnings before interest and taxes, also called operating income. Cost of goods sold and operating expenses have been subtracted. Interest and taxes have not. Question 8. Is diluted EPS always higher, lower, or equal to basic EPS? The correct answer is always equal to or lower than basic EPS. Dilution adds shares to the denominator, which reduces earnings per share. Question 9. Why do analysts typically strip out non-recurring items before forecasting future performance? The correct answer is because non-recurring items are one-time gains or losses that shouldn't be projected forward. They don't reflect the company's ongoing, sustainable earnings power. Set 3. Balance sheet and liquidity. Question 10. What's the difference between the current ratio and the quick ratio? The correct answer is the quick ratio excludes inventory from current assets, since inventory can be slow or hard to convert to cash at full value. It's the more conservative liquidity measure. Question 11. Assets and liabilities are both ordered on the balance sheet by what principle? The correct answer is liquidity for assets, how quickly they convert to cash, and maturity for liabilities, how soon they're due. Question 12. What increases retained earnings and what decreases it? The correct answer is net income increases it, dividends paid decrease it. Set 4. Cash flow statement. Question 13. Name the three sections of the statement of cash flows. The correct answer is operating, investing, and financing activities. Question 14. Under the indirect method, why is depreciation added back to net income? The correct answer is because depreciation reduced net income but didn't actually use any cash. It's a non-cash expense. Question 15. Receivables increase this period. Do you add or subtract that increase when reconciling net income to operating cash flow? The correct answer is subtract. An increase in receivables means a sale was recorded, but the cash hasn't been collected yet. Question 16. Accounts payable increase this period. Add or subtract? The correct answer is add. An increase in payables means the company owes money but hasn't paid it yet. It's holding on to cash longer. Question 17. State the general rule. What happens to cash flow when an operating asset increases versus when an operating liability increases? The correct answer is an increase in an operating asset subtracts from cash flow. An increase in an operating liability adds to cash flow. Set 5. Inventory, FIFO versus LIFO. Question 18. Under FIFO, are the oldest or newest inventory costs expensed first? The correct answer is oldest costs first. Question 19. Which inventory method does IFRS prohibit? The correct answer is LIFO, last in, first out. It's permitted under US GAAP but not IFRS. Question 20. In a period of rising prices, does FIFO or LIFO result in higher reported net income? Why? The correct answer is FIFO. It expenses the oldest, cheaper costs first, so cost of goods sold is lower and net income is higher. Question 21. In that same rising price environment, which method, FIFO or LIFO, tends to leave the company with more actual cash and why? The correct answer is LIFO. It reports lower net income and therefore lower taxable income, meaning lower taxes paid. So despite looking worse on the income statement, it can leave more actual cash in the business. Question 22. If a scenario tells you a company uses LIFO, what can you immediately conclude about which accounting framework it follows? The correct answer is it must be a US GAAP reporter, since IFRS doesn't allow LIFO. Set 6. Long-term assets, liabilities, equity, and taxes. Question 23. What's the difference between depreciation and amortization? The correct answer is depreciation applies to tangible assets. Amortization applies to intangible assets with a finite life. Both spread cost over the asset's useful life. Question 24. Does goodwill get amortized on a routine schedule? The correct answer is no. Goodwill has an indefinite life and instead gets tested for impairment, at least annually. Question 25. A bond is issued at a discount. Is the effective interest expense higher or lower than the stated coupon rate? The correct answer is higher. A discount means the effective yield at issuance exceeds the coupon rate. Question 26. Does a stock split change total equity or the company's actual value? The correct answer is no. It changes the number of shares and the per-share numbers, but total equity and company value stay the same. Same pie, more slices. Question 27. What creates a deferred tax liability? Give the classic example. The correct answer is a timing difference where less tax expense is recognized now than will eventually be owed. Classically, using accelerated depreciation for tax purposes while using straight line for financial reporting. Question 28. Does a permanent tax difference like tax-exempt municipal bond interest ever create a deferred tax asset or liability? The correct answer is no. Permanent differences never reverse, so they never create a deferred tax item. They're simply excluded from taxable income forever. Set 7. Reporting quality and ratios. Question 29. Revenue is growing much faster than cash collected from customers. What might that signal? The correct answer is potentially aggressive revenue recognition, a financial reporting quality red flag worth investigating. Question 30. Name the 4 broad ratio categories covered in FSA. The correct answer is liquidity, solvency, profitability, and activity ratios. Question 31. Which ratio category does debt to equity fall into? The correct answer is solvency. It measures long-term financial risk and leverage. Question 32. Net income keeps climbing while operating cash flow stagnates or falls. Should that raise a flag? The correct answer is yes. Net income and operating cash flow should generally move together over time. A persistent divergence is worth investigating as a possible reporting quality issue. That's 32 questions covering the three financial statements: inventory accounting, long-term assets and liabilities, deferred taxes, and ratio analysis. FSA concepts show up again and again in equity and corporate issuers, so revisiting this set pays off well beyond this one topic.